To an untrained eye, a live price chart looks like pure visual noise. It's a barrage of red and green ticks jumping across the screen, seemingly governed by nothing but chaos. This feeling of unpredictability is backed by the data. Markets only move in clear, trending directions about 25% of the time. The remaining 75% is spent in chop, ranging or giving off hard-to-deduce signals that lead many retail traders into losing positions. But prices rarely move in a vacuum. Instead of a straight line, the market moves in waves of expansion and contraction, a sequence that follows a distinct structural logic. Professional smart money traders don't rely on gut feelings or lagging indicators to navigate these waves. They look for footprints left by institutional operators, reading the mechanical architecture of price to identify where the path of least resistance lies. Uptrends are staircases, where buyers push price to higher highs, supported by higher lows. Downtrends are the inverse. Sellers drive price into lower lows, capped by lower highs. A range moves sideways between equal highs and lows, signaling a deadlock. Identifying these states isn't about predicting the future with absolute certainty. It's about using a systematic framework to categorize whether buyers or sellers currently have the momentum. To see a break of structure in an uptrend, the price forms a higher low, then surges past the previous swing high. Confirmation is key. The price must close with a full body past that line. A thin wick means it hasn't broken yet. The reason for this specific pattern is often liquidity hunting. As a price rises, early buyers set their stop losses just below the recent lows. The market often pulls back specifically to trigger these sell orders, creating a temporary dip. When those stops are hit, it creates a massive pool of sell-side liquidity. This allows institutional players to enter buy orders at a better price, providing the necessary volume to propel the market to its next high. This is why a BOS is rarely treated as an entry signal on its own. Instead, it serves as structural evidence that the trend has enough institutional demand behind it to continue its current trajectory. But even the strongest trends eventually reach a point of exhaustion. The question is how to recognize when that predictable staircase is beginning to fail. This shift is a change of character, or CHoCH. In an uptrend, the price fails to set a new higher high, plummeting below the most recent higher low. Ignore minor internal dips. A true reversal breaks the major anchor point holding the trend together. On a live chart, this might be labeled as a market structure shift, or MSS. Regardless of the name, the implication is the same. The short-term delivery of price has flipped from the buy side to the sell side. A change of character acts as an early warning system. It alerts you that the market's behavior has transitioned from continuation to a potential reversal, allowing you to adjust your bias before the trend fully turns. Professional traders rarely trade these shapes in isolation. To increase the probability of a setup, they layer these concepts across different timeframes. It starts with a higher timeframe, like a daily chart, to identify the macro trend. By locating an overarching BOS or CHoCH, the trader establishes their primary directional bias. From there, they zoom into a lower timeframe, like the 5 or 15-minute chart. This allows them to see the smaller waves within the larger trend, helping them find a precise entry with a better reward-to-risk ratio. The high probability setup occurs when the microstructure aligns with the macro flow, such as waiting for a 5-minute CHoCH to occur just as the price reaches a major daily resistance level. This multi-timeframe approach ensures that even small, localized trades are supported by the broader flow of institutional liquidity. If we go back to that original, chaotic chart, the movement still looks erratic to anyone staring at the flickering numbers. But when you apply a structural framework, the noise begins to dissipate. You're no longer guessing at the next tick. You're following a repeatable pattern of highs and lows that organizes the chaos. As long as the price continues to break structure in your direction, the trend remains intact. This provides a logical basis to maintain your position, rather than exiting early due to minor pullbacks. The moment a change of character appears, you have the evidence you need to exit. It's a signal that the sentiment has shifted and the momentum is likely heading the other way. The market is always subject to shocks and uncertainty, but it isn't entirely random. By understanding market structure, you can stop fighting the noise and start following the footprints left behind by the smart money.